Good morning. This is Mornings with Michael, the weekend edition, weekend update. Hope everyone is doing well. We're back in the Bay, returned from the beach. So let's get right to it. Wearing purple today to celebrate the life of Bud Grant, coach of the Minnesota Vikings. Our sympathies go out to the Grant family. And let's get to our market. I'm going to share our screen. First, I'm going to pull up some of the market averages here. I think there's still a pretty good chance that we take out the 2020 lows. Let's just take a look where that would be. Guess we have to go to our monthly chart. 2020 lows is right here. Somewhere between 164 and 219. And that's on the NASDAQ. Currently, we're at 288. So that would be 219. That would be quite a swoon. And we'll take a look at the S&P 500. Their market lows. Low was 218. And Leon Cooperman is calling for 310. So we'll just have to keep an eye out for that. Let me go to let me go around, take a look at what has been trending in the ETFs over the week. Utilities have been holding up, but this is pretty huge volume on their retreat. Communications had been holding up pretty well. And look at this volume. That is just massive volume, and it didn't move down too much. So that's actually a good sign. XLK technology had been holding up pretty well. It actually bounced, but had a massive volume again, huge pull down in the market. So real estate is really suffering with all these interest rate increases. Industrials looks pretty ugly. Once again, look at that volume, pretty huge. Healthcare hadn't been doing too well, and it just continues. And once again, look at that volume down on Friday. Financials, of course, led the route with 2 banks going under in California. Really believe the regulators failed to do their job with all the interest rates rising at such a speed, and understanding that bond rates and treasury bill pricing, or actually the prices on both, are falling precipitously. Why they didn't have this under control is beyond belief. And XLY, consumer discretionary, continues to pull back. Once again, look at that huge volume. And XLB, our builders, really continue to plummet after the Fed speak earlier in the week. This has just been plummeting. And let's take a look at our transportation. Pull back as well in pretty huge volume. So let me bring up our presentation on PowerPoint. This is a VIX. The VIX spiked up pretty close to 29, 28.97. Huge move up here. I think that the VIX is pulled back quite a bit. I think it's going to pull back some more, possibly later in the week. And I'll show a little later. So this is the S&P 500. It's quite a ways below the moving averages, and markets don't really like to be that much above the moving averages or below the moving averages. So I think it's possibility it could come down possibly Monday or Tuesday some more, and then try to fill this area before we have a further retreat. This is a QQQ. Same thing on the QQQ. I think it's possibility it can come down again. May even try to come back on Monday afternoon. This is the IWM. Came up here, hit resistance, and it's just been continuing to sell off. I think it's going to be pulling back, and then it's going to try to fill this gap here before it would come down any further. This is huge volume here, but it's both of the CCI and the stochastics are really on their lows. We'll just watch for a bend. There's a little bend here on the CCI, so that's what I would look for. Solar energy production could require most of global silver reserves by 2050. So I would continue to watch gold and silver, which had been popping up with the dollar pulling back and yields dropping precipitously on Friday. The PE ratio versus a 2-year yield is the widest point in going all the way back to 2021. The German bond yields are above 3% for the first time since 2008, so that's kind of an eerie look back. Wartime scenario unfolds as Taiwan suspects Chinese ships cut undersea internet cables on purpose. China threatens U.S. with conflict and confrontation. They really don't like are investigating and publicizing what really caused the COVID pandemic. So we'll continue to look at this. This is the inversion of the yield curve. The 2-year rate is much higher than the 10-year rate, up nearly 5%. There's a lot of CDs, 12-month CDs. Now you can get it over 5%. And I think I saw a couple of banks were offering over 5% 12-month yield for a CD. Real U.S. money growth shrinks to the most since the 1980s. This is really amazing. 401k hardship withdrawals rise as increased costs of living challenges retirement savings. And we kind of saw this in the last couple of weeks presentations and the weekend update, where some of these car lenders have been going out of business. Millennials are sinking under the weight of their debts, heading to a record 3.8 trillion to the pile in the last quarter. And this is our last slide. Kind of went through the slide share backwards, but similarities are scary. Equity blow off top coming, could be larger than the market crash of 2007 to 2009. And Henrik Zeberg even thinks it could be worse than 1929. AJ Monty of Market Rebellion has been calling for this as well, and has said that all the averages are going to take out their 2020 lows. So we'll continue to watch this. Once again, if you have any personal finance questions, feel free to get in contact with us. I've been saying all along, I feel this is a time that it'd be better off being in an annuity. An annuity is giving bonuses right now. There are different annuities that are given up to 32% bonus on your deposits, and let them manage all the volatility. That's our show for this weekend update. Hope everybody has a great weekend. Continue working on your goals and your activities. That is what is going to pull us through this recession, which all recessions are necessary to squeeze out the excesses, and then we can invest in our economy and people moving forward. All the best to you, and this has been Mornings with Michael for informational, educational, and entertainment purposes only. Thanks for being here.